Losing hurts more than winning feels. Good twice as much. Actually, this is loss aversion, fundamental bias affecting every financial decision you make. Daniel Kahneman won Nobel for documenting this. Prospect theory explains how people value gains and losses asymmetrically. Losing $100 hurts more than winning $100 feels good. The ratio is roughly 2 to 1. Losses feel twice as bad as equivalent. Gains feel good. This isn't logical, but it's human, universal, persistent, predictable. This creates problems in investing. Hold losing stocks too long, hoping to break even, sell winning stocks too quickly, lock in gains. This is backwards, but common, universal, almost. The psychology is clear. Selling loss makes it real, permanent, painful. Holding loss keeps hope alive. Maybe it'll recover. Maybe I'll break even. Then I'll sell. This is mistake. Taxes favor opposite behavior. Sell losses for tax benefits. Hold winners for long-term gains. Lower taxes. Logic says cut losses. Let winners run. Emotion says opposite. Emotion wins, usually. Loss aversion keeps people in bad jobs, relationships, investments. Fear of losing what they have prevents pursuit of better opportunities, even when current situation is mediocre or worse. Sunk cost fallacy related to loss aversion. Already invested time, money, effort. Don't want to waste that investment. So continue down bad path. This is throwing good money after bad. But past investment is gone, irretrievable, irrelevant to future decisions. Only question is forward. Looking, does continuing make sense? Now, with information available now, past is sunk. Forget it. Status quo, bias, also related. Prefer current state over change, even when change would improve situation, because potential loss looms larger than potential gain. This keeps people stuck. Framing matters enormously. For loss aversion, 90%. Success rate sounds better than 10%. Failure rate, same information, different frame, different emotional response, different decision. Marketers exploit this. Don't lose out. Last chance. Limited time. All trigger. Loss aversion, fear of missing out, drives purchases that wouldn't happen otherwise. This is manipulation. The default effect uses loss aversion, what's presented as default, usually chosen because switching feels like loss, even when no loss actually occurs, just psychological frame. Overcoming loss aversion requires awareness. First, notice it in your decisions. Holding loser, avoiding change, paying attention is first step, always. Second, reframe decisions. Focus on opportunity, not loss. What do I gain by cutting this loss? What do I gain by changing the situation? Flip frame from loss to gain. Third, set rules. Before emotion hits stop loss at 10%, down, rebalance annually, regardless of market. Pre-decided rules. Remove emotion from decision point. This works. Fourth, practice small losses. Get comfortable with losing. Small amounts in controlled ways. This desensitizes loss pain, builds resilience for bigger decisions later. Fifth, think probabilistically. Not every decision will work. Expect losses sometimes. That's normal. That's portfolio approach. One bad investment doesn't mean process broken. It's probability. Sixth, zoom out. One loss in context of many decisions matters less. Long-term trajectory matters more. Don't let one loss dominate thinking or future decisions. Loss aversion is hardwired, cannot be eliminated, but can be managed. understood, compensated for. This is emotional intelligence, financial intelligence. This is maturity in money, decisions. Accepting losses is part of winning. Long-term, cannot have. All gains, no losses, not realistic, not possible. Successful investors accept losses, cut them, fast, move on to next. Opportunity. This is way.